people are waking up to that gold is the only really long-term monetary asset that will hold its value, and they're waking up to it, and that's why there's a rush for physical gold. Tuesday, February 10th, 2026, Maneco 64, home of alternative economics and contrarian views. We're going to look at the dollar index, and I want to talk about the history of the dollar index today as well, because I think there's a lot of misconceptions about what the dollar index really is pointing towards, especially vis-a-vis gold. But be as it may, technically it looks like the dollar index is on the precipice of a major move lower. I don't think we're not going to make new all-time lows like we did back in '08, but we could definitely see a move that is equal to what we saw from December 2024 till July last year. Yes, kind of like another leg down. And I think the Federal Reserve is aware of these problems. It's a liquidity problem. And why is that? Well, we saw yesterday that the Chinese government has come out and told its banks to try to avoid buying U.S. treasuries or omit buying them altogether. We're seeing that the Chinese central bank is continuing to accumulate a lot of gold. Yes, the official figures don't seem like a lot, but the estimated figures by banks like Goldman Sachs is pointing to a big move from China into gold. And of course, the currency that gets hurt with a move to gold, not just from the Chinese perspective, but from all the other non-NATO or Western countries who are buying gold hand over fist, is the U.S. dollar. It's people are abandoning gradually the concept that the dollar is the risk-free asset that they need to hold via T-bills, notes, and bonds. And people are realizing that the dollar is not a very good store of wealth, and that gold is, and the dollar index will show you this. Even though we could see a move lower in the dollar index help gold quite sharply, I'm going to go back historically and prove to you that, yeah, it's not as it seems. And I think de-dollarization, also big investors, institutional investors, sovereign wealth funds, central banks, very wealthy individuals, they're realizing this. They're realizing that the dollar might be a good form of payment and transaction internationally, but as a store of wealth, as a store of value, it's failing. And I've been trying to warn people since, well, when I started this channel in late 2015, that the dollar index is kind of a distraction, that in the end of the day, you want to have gold. The other thing that is hurting, aside from de-dollarization, and it's connected to de-dollarization, is the runaway spending that we're seeing by the United States Congress. The deficits are continuing to run almost at, well, around 6%, maybe 5.5% in the next fiscal year, and 5.2% in 2027. And I've got the CBO deficit, official deficit projections. And we know the CBO usually underestimates bad things and they overestimate good things. So for the current fiscal year, they expect a deficit of 6.2% of GDP, and that's humongous. That's akin to a deficit during a crisis, during a recession. For the 2026 fiscal year, which starts this coming October, they expect it to drop to 5.5%, yeah, which is an improvement. But then the next fiscal year, 2027-28, 5.2. But what is concerning here is that for 2028 fiscal year, they expect it to go back to 5.9, which is almost like where we are right now. So no progress. I've heard Treasury Secretary Besant saying that he wants to get it down to 4.4. I think last year he was talking about 3%. So it's getting harder and harder. So that's the underlying fundamental problem. These deficits, of course, they accumulate into the national debt, and as foreigners show up less and less at the treasury auctions because they want gold, this is going to get more and more difficult. And I think this is what the dollar index chart, which I'm going to bring up here now, is showing to us. So I've got here a monthly chart of the dollar index, and you can see that we've been on an upward channel since since the low, basically in 2008, March 2008. That low was around 70.69 or 70.70. Yes, it's trying to hang on here onto this trend line since the lows last year, but it really looks like it's gonna keel over. It looks like a bear flag, and I've done a little bit of projection here from the high in 2024, around 110, to the low last summer. I took that leg down and I projected it from that trend line, and the objective is around 85, and you can see how that trend line, long-term trend line, is really important. The dollar index is trying to hold on to that, but I think we're gonna fail here, and yes, that could propel gold a lot higher. But I told you there's a lot of misconceptions about the dollar index and gold. And it's true that in the short term, the way the dollar index moves is usually inversely related to gold. So we could expect a move lower here in the dollar index to get gold to move above the recent high at 5,600 and go even to 6,000 or 7,000, I would say. But if we look at the long-term picture of the dollar index and gold, what it shows me is that it's a major distraction for investors. And what is the distraction? Well, the distraction is that you should hedge dollar weakness with other fiat currencies that are going up against the dollar, and vice versa, right? But if we go back to the beginning of when the dollar index was instituted back in March 1973, it started at 100. And in the month of March 1973, gold closed at $90, and the dollar index closed at 101.17. So right now, as I speak here, it's 7:55 a.m. London time, and the dollar index is at 96.90. So it's down about $4 since 1973. And is gold trading at 90? No, gold is trading at 5,030. So what this is saying is that all fiat currencies are sinking. Not just the dollar. And I think people are waking up to that gold is the only really long-term monetary asset that will hold its value, and they're waking up to it, and that's why there's a rush for physical gold. And this move down in the dollar that I see coming, and I don't know what's going to trigger it. It could be a crisis. It's going to accelerate the move to gold even more. And it's not to say, though, that if we move down to 85, it doesn't mean to say we couldn't move back to 100, but gold would still be a lot higher, I think. So I've got a few other points I wanted to make. More recently, in 2008, for example, the dollar index bottomed in March 2008 at 70.69. That's the all-time low. And the price of gold topped at 1,032.85. So here we are now, gold again 5,000 and the dollar 96.90. So yes, gold can go up even when the dollar index goes up, at least in the long term, which means, yeah, other fiat currencies are really bad substitutes for dollar weakness. And I think central banks are waking up to that, and you should be waking up to that as well, especially if you live in a non-dollar country, if you live anywhere really. Another little analysis I did is from the week of November 30th, which was the low in gold, 2015. That was 1,046.50. That was the low in gold from the high in 2011. And at that time, that same week, the low in the dollar index was 97.59, and the close is 98.35. So pretty much where we are right now, but gold has gone up like 5 times since then. So that's crazy, isn't it? It just goes to show you need to be in gold and silver for that matter. So what do I think the Fed might be doing if we see a major crisis? And it could be a crisis, like in the shadow banking sector, like private equity, private credit. I think liquidity is drying up because, as Ray Dalio said, he did a really good interview with Tucker Carlson. I recommend it. The supply of dollars keeps growing. That's because of the deficits that the Uncle Sam is running. But foreigners are, not just for political reasons, but also for fiscal reasons, they're trying to avoid the dollar as much as possible. They're going for gold as a store of wealth or value. And yes, that means that there's less liquidity domestically for the U.S. Foreigners are not like playing ball anymore. So I think what the Fed will have to do is step in. They will probably have to cut rates aggressively, even intra-meeting, and they will have to step on the gas in terms of QE, and that's going to hurt the dollar. That's going to make gold and silver fly even more than they have in the last 13 months or so, and it's going to help all other hard assets. So keep an eye on the dollar index, and I think it's pointing to the next crisis. But the other thing I would say, and it's the most important thing you should take from this recording that I'm making, is that the best way to hedge dollar weakness is with gold. And dollar weakness is just fiat currency weakness. And all the other countries, they're going to step in. Once the Fed reacts and cuts and prints, they're going to join in, and then the dollar will pick up again. And it's this cat and mouse game that they play. And you want to have the gold. Yeah, you don't want any of the IOU nothings fiat currencies. So with that, I'm going to wish you all a very good day. Take care. Bye.